Good afternoon, everyone. Thank you very much for joining our business broadcast today. So today we are talking about finance for non-finance managers. So I'm targeting both groups here. So it's those accountants out there who don't understand why people that they're talking to understand what they're saying, but also to those non-finance managers who actually want to understand what on earth what's their accountant talking about. Now, this is a really popular course. If you those of you who've ever worked in corporate, as I have, I was a finance manager for many years for non-finance departments. So this was a regular course that the non-finance managers would have. So it was really important that I could communicate clearly to the non-finance managers so that they could run their profit centers. So that's what we're going to go through today. We're going to go through several sections. It will be a bit of a whistle stop tour because there is, accounts and finance is a huge amount to go through. But what I want to make sure is some of the key messages. If you're a non-finance manager out there, what are the key things that you should be focusing on? If you're going, I don't understand what my statutory accounts are. I don't understand what these management accounts are in front of me. Just to try and deconstruct, delayer some of these elements so that at least, I'm not expecting you to be a fully qualified accountant by the end of the 30 minutes, but at least to know what are the things that you should be looking at, what sort of questions should you be asking, and what you want to be able to make sure that you're delegating to your finance team so that you can manage your department or your business to the best of your ability. As always, just a few bits of housekeeping, just in case you don't know who I am. My name is Nikki Larkin. I'm the MD of Gorringe Accountants. I am also NED for some businesses, and my background is in industry. And then I've gone into practice, which is very unusual because normally it's the other way around. But it does mean that it gives me a unique perspective, as in I can understand why the people in industry get so frustrated with their accountants. You need to make sure those accountants out there, you need to make sure that what you're communicating to your colleagues, your non-finance colleagues, and your perhaps non-finance clients, you need to be clarifying and being really clear in what you're talking about. It's really important to stop the accountants speak and actually understand why and what you're looking at, and get to there. So also, just to remind you, as always, we are live on YouTube and on LinkedIn Live. If you put comments in the comment box, they should come through to me. So please do. Any comments you want to share, any questions, please fire them away. I'm willing to answer anything to do with accounting or tax or finance in this section. So make the most of this 30 minutes. So I'm here to help you. Right. So we've got, for those that you pre-booked, you'll have seen the basic structure of today. I'm going to be talking about why cash flow is so important, as in why is cash king. I then will be touching on how to have cash management in your business. I'll then be going through accounts receivables because that really flows in from the cash. Talking about budgeting. Then I'm going to just touch upon the different types of costs, because you will hear different words, overhead, capital expenditure, variable cost. What are they? Let's look at those and try and get rid of that jargon so that you can actually understand what those things are. We're going to just have a brief look at how do you read a profit and loss statement, and then also some key things to be looking at balance sheets. Now, all of that could actually become a full day course or a full 2-day courses. And in fact, in corporate, often you do have a whole day, if not 2 days, going through all those things in detail. So I do apologize that I'm going to be steaming through things, but that's why it's really important that any questions that you have as we go along, please do say, because if I am talking jargon in this, then I'm not doing my job at explaining finance to non-finance managers. So please do pick me up, and please do ask any other questions that you would like covered in there. So start off, your business, your charity, your department cannot function without cash. Cash is king. So, there are so many different elements to accounting and finance, but this is the top priority. So you really need to understand cash. If you can't pay the bills, if if you can't, you know, get buy your stock to sell to your clients, or pay staff, any whatever it is, you need to fix that, and you need to understand that. So cash is king. Now, cash, you think, well, okay, well, surely that's just really simple. That's the money that is coming in from your clients. Actually, it's a little bit more complicated than that. Cash can come from various sources. So I'm going to just talk through the three main areas, and this might give you some bit more idea of how to help into the next section, your cash flow management. So three main areas that cash can come from. Number one, which probably you've straight away thought of, is, well, surely you get the money in from your clients, so it's your revenue. So yes, absolutely, cash from revenue is it's obviously part of the mix, part of the cash flow mix. However, it's not the only thing. You also do have lots of businesses that are pre-revenue. So the Twitters of the world, they didn't have cash on day one from clients. They had to build up their proposition before they actually became a post revenue business. So how do you fund that gap? That's that cash gap. We're not talking tax gap today, Guy. We're talking cash gap. So what you would be looking at, until you are in that sustainable pattern of cash from your clients, and again, that is different timing there as well. You could be funding your business, usually in two different ways. Either capital that you've put into your business yourself. So you might have put in, say, £10,000 of share capital to start it off, kick it off, pay those initial bills, for example, or whatever. It might be in the millions, but that's cash going into paying for shares, and that's capital that stays in the business unless you do something which is really complicated, a share buyback. We're not talking about that today, but unless in general, that capital stays in the business. So it's there as a cushion. It pays for what you need it to pay, but it stays in there. And why I'm really emphasizing that is because the other alternative, people might think, either I don't have my own capital to put into my share capital at the beginning. So, and perhaps they don't know other people at the beginning to help put in equity, or they might be saying, I don't want to give my equity away. I've had this fabulous idea. Why would I want to give away the share in my business? So that's when they start looking at debt. So debt financing. So that debt financing, there's all sorts of complicated words out there, but basically it's somebody lending you money. It can be done in lots and lots of different ways, but whatever it is, debt financing is somebody lending it to you. It may be in different ways, and that will get complicated. And again, I could spend a whole hour probably on that section, but just a sec. So cash is king. You need to be looking at, are you getting the money in from your clients to keep your business from? And also the timing on that's really important. Look at your payment terms, look at how you invoice. Are you going to be doing some, money up front for a discount? A lot of really successful software businesses they charge for 3 or 5 year licenses. So they've got a lot of cash on their balance sheet, but it's actually for future revenues. So that cash is king, whether it's going to be from your clients or customers, whether it is from the capital, from you and your shareholders, or from debt financing. Those are the three it comes from. So then you know where the cash is coming from, but you also need to go where it's leaking out. So you need to see what money is going out. Is it going on staff? Is it going on products, research and development? Infrastructure, the offices, what is it being spent on? And that's why it's really important to have, especially when cash is an issue. It could be because you're in a big growth period or it's a very lean period. You need good cash management tools. Now, that could be as simple as having a spreadsheet listing everything that's coming in, everything that's going out, and seeing what the net balance is. Sort of, if you look at your bank statement, basically producing like a future bank statement for your business. That's basically what you're doing. You can do it in all sorts of fancy whirly formats. Some of the software even does some of that prediction for you. Just note on that software, a lot of the software, it only forecasts it based upon the historicals. It doesn't always put in things that So if you've won a new contract, it might not know, well, actually, of course, my business is going to be increasing by 50%, because it doesn't necessarily know unless you've got a more sophisticated software there. So I would at least start with the very basic, at least on a spreadsheet. If not, use one of the tools. But you really need to know, when are the tight spots. So our tight spot always is the lovely, delightful VAT part of the quarter, because that's our biggest bill that we pay each quarter. It goes to the lovely tax man. So lots of people's VAT bills did go out yesterday if you're on direct debit and you're on a December quarter. So that is the bottom period of your cash flow. So you need to mitigate that. Make sure you bring in as much money as possible so that you cover for those leanest periods. Okay. And that cash management, that might be done by you, or it might be done by your finance department, or you might have a really good administrator that can jot that down, so that you can hopefully not have any surprises. Next, going on to is accounts receivable. So accounts receivable. Now that is again, it's all about jargon here. There's accounts receivable is also known by different names, but let's just explain what accounts receivable is. Accounts receivable, at its simplest form, it's a list of the invoices that you've issued to your customers that haven't been paid as yet. Now, you may not call it your accounts receivable in your company. You may be calling it your sales ledger list. It might be calling it your aged debtors. All of it, it doesn't matter what it's called. It's the same thing. It's what is owed to you by your customers at this point of time. And that accounts receivables report is really important to understand. Really important to know who owes you what, making sure you keep on top of that. Some of them you may have different for different reasons. You may be giving them different terms, but you need to understand why. And obviously you want to make sure that none of it actually turns into bad debt and you completely lose it. And bad debt, again, jargon, bad debt, it's sort of what it says. It's where you've provided a service or a product for a client, and for whatever reason they aren't paying. It could be because they weren't happy with the product or service, or literally they just can't pay. And then that is called bad debt. Okay. As I said, do you ask any questions as we go along? Accounts receivable, though, hopefully that's quite straightforward. It's a list of your debts by your customers. debt, your customers' debts to you, that is. Uh, I'm now going to go into budgeting, which, as most of you know, is one of my favorite subjects, but I'm going to keep it simple. Or I'm not going to talk about how to do budgeting. I'm just going to talk to you what a budget is and what the purpose is. So, a budget is what a framework of costs and sales and uh, cash flows. It's a framework of all your different finances, but forecast into the future. So usually, with a budget, you want to try and stick to it. No one's ever going to hit their budget exactly. That's why it's a framework. You want to hit your budget, or you want to exceed your budget. You want to do better than that, but you don't want to come under the budget. But it's something, so you've got that plan, because usually you will have a budget. Sorry, you will have a business plan that backs up your budget. It's pointless just having a list of numbers on a page if you haven't got a plan in order to make those budgets happen and make them be achievable. But you would at least want to have some sort of budget. At the very minimum, have a sales budget so you know how much sales that you're trying to target, so that you can measure your salespeople. But ideally, you'd have a full profit and loss budget. So you'd have a budget for your costs, a budget for your sales, and from that you can extrapolate your cash flow forecasting, and what your balance sheet is going to look like. Balance sheet is a snapshot of the business. I will go in a bit more detail about that later. But budgeting, really, really key. I am astounded about the amount of SMEs that do not have budgets. Um, you know, they might be doing really well and thinking, well, why do I want to budget? But honestly, the firms that we deal with that do really well, the most successful ones, they are the ones with a budget. Because even if you're in a period of not doing so well, you then can actually have a framework to work from and look at, well, why am I not budgeting for higher levels? What can I do to increase my sales? Um, Guy's come up with a question from our previous section about accounts receivable, and that's something. Yeah, so this is all about credit control, because you'd want to have good credit control. So he's saying, I've known some firms charge interest so their invoices aren't paid on time, and in fact that is a legal thing that you are allowed to do. There's set things that you can put. You often see it on people's T's and C's. It's in our T's and C's. You can charge interest if people are late. Some people actually charge specific fees on top as well. And they warn that interest will be charged on late day payments. I mean, we to be fair, we've got pretty good clients that do pay us. So it's although we do threaten interest, it's very, very rare that we've ever followed through on that. It's a bit of a soft touch, but please don't. Hopefully, if you're a client, you haven't heard that. But if but yeah, it's a very useful tool. And you are entitled to charge that. So if you want to, sometimes it can sour the client relationship. So you have got to use that advisedly, if it is the best thing for you to do or not to do. Okay, so I went through budgeting. Key message there with budgeting: have a budget. It's about what the future numbers are going to look like. In fact, a phrase I used this morning, it's a numerical portrait of your future. So I quite like that phrase. I'm going to continue using that one. Okay, let's go to costs. So there's lots of different types of costs, but they do get categorized in some certain areas. Yeah, sorry, Nigel's just backing me up on that, with chasing in charging interest and late charges and things. Hard call, it's all about customer relationships. Absolutely. If it's a one-off piece of business done with the client, you probably aren't bothered about charging them extra because you're not expecting them to come back again. But if you're wanting to have a long-term relationship with a client, it can be quite difficult to do that. But to be honest, I find just the threat of that is usually enough to get people into action. Okay, so um, types of costs. Okay, from a financial perspective in any reports, they will be usually split into three types of costs. You've got your direct costs. So those are what you call variable costs. So they move and they change. So the higher your, so there we go, higher your revenue, the higher your costs. Hopefully the costs are smaller than the revenue. But so the variable ones. So for example, if I said, everyone seems to be talking about staples at the moment, so I'm going to use staples. So say you're a stationery supplier and you sell staples. I know what it was on Wednesday's webinar. Daniel kept talking about staples. So if you're a stationery supplier selling staples, the more staples you sell, the more you're going to be buying from your manufacturers. So that is a variable cost because that becomes a direct cost. You only have that cost if you're selling them, and it's a direct cost and it's variable because it keeps moving. The more you sell, the higher your direct cost is. Other things in your direct costs, it could be, in accountancy practice, all of our billable staff are variable costs. The more sales we're doing, the more variable cost staff we hire. So, they are a direct cost to us. So as Guy builds up his empire, his direct costs will keep increasing because he'll have a bigger and bigger tax team. So that's your variable cost. They move. So that's why they're the thing that's immediately after the sales. They're at the top. And and actually that's I'm going to skip a bit into my next section as well. In your P&L, your profit and loss account, or some people call it income statement, at the top you have sales. Next you have direct costs. If you take your direct cost from your sales, you get gross profit. So lots of people are always talking about gross profit because you want your gross profit to be as healthy as possible. So that's a real key thing. Underneath that, you have overheads. So those are often the things that you will pay for. You might, even if you have zero revenue, you still have to have your business running. You have to have those overhead costs. So they may be your accountancy fees. They may be the rent for your factory. They could be the electricity for the factory. It could be marketing expenditure. Before you sell a single thing, you still will do a certain amount of marketing. Now, some of those overhead costs are also variable, but a lot of them are fixed or at least stepped. So stepped means that they go up at different levels of your revenue. As your business gets to different sizes, they go up a step. So they're called stepped costs. So your overhead. So often when people are looking at trying to go, oh, okay, I'm not hitting how much profit I'm making. Perhaps I'm only making £500,000 profit, and I wanted to be making £1 million profit. So often what they will look at is the overhead costs first, because is there anything in there that they could lessen? So could they move to cheaper premises if they're near to their lease time, or could they, for example, outsource their finance department to the Philippines and get a load of savings? There's all sorts of different things that they can do there. That's, they're looking at their telephone suppliers, looking for the best deal, all those sorts of things. You want to cut down those, making that as efficient as possible. how are we doing for time? See, I'm rattling through here. Then the other thing, so we've gone through direct costs, we've talked about overheads. The third cost is capital expenditure. So people often get confused with that. What does that mean? So capital expenditure, those are things which are considered long-term assets. So they might be called a fixed asset, but they're things like computer equipment, or buying a building because you won't want to pay rent anymore. So you're buying a building. Those capital costs, they're not um, they're not extinguishable. So they've got a longer value. They've still got a value in a few years' time, and so they're called capital. And you can often get better financing on things like that because they retain a value. So that's really important. So that's capital expenditure. So we've been through direct costs, we've been through overheads, and we've been through capital expenditure. There's also, you will find, especially in larger businesses, and in fact in our government as well, they will have different budgets for their normal costs, their revenue costs as they call them, versus their capital costs, because they can get different types of financing for those. And that's why they particularly focus on that. And yeah, so that's why they split them off. One of, excuse me, just one of the reasons why they split them off. Okay, we've only got 4 minutes left, so I'm just going to go through what the basic parts of a profit and loss, especially as I've already been through quite a bit of it, and we'll have to leave balance sheets for another time. So a profit and loss statement, this is really important because although, yes, your business is not going to survive without its cash, in long term, your business is not going to survive without profit. So a profit and loss, or as it more in modern times is called an income statement, that shows you what profit you've got. What that's going to have at the top, it's going to have your sales. So it's all those staples that you're selling. Then it's going to have your direct costs. So how much it's cost you for those staples. Then it's going to have your overheads. So your overhead staff, so your administrators, your rent for your building, your insurances, all of those sorts of things. When you take that figure off, you come to your net profit. So that's a really important figure. You also hear people talking about EBITDA because it's your earnings. So net profit or earnings, they are essentially the same thing. It's how much are you earning from your business? Hence, it's called earnings. But it's a profit. So, are you making profit? Because you want to be making a profit and not a loss. Just final, because it's a bit of jargon which people are throwing about all the time, but it's really important for you to understand, is EBITDA. So that's earnings before interest, tax, depreciation, and amortization. So that's the bit that we've got to. Underneath, for various different reasons which we don't have time to go through, those other types of costs, the interest, the depreciation, amortization, they're often considered slightly differently. So often people are making their decisions upon EBITDA rather than the very, very bottom profit. Anyway, as I said right at the top, this is going to be a whistle stop tour, which indeed it has. So then I've loved having you here for today. Thank you very, very much for joining me. Any questions you have, please do let me know. We will be going in more of a deep dive into some of those areas in um, our future business broadcasts. But thank you very much for joining me today. Any questions that you have subsequent to this, please do contact me on LinkedIn. I'm usually always there, so lurking around. So please do contact me. Happy to help, because I know how overwhelming it can be if you're a non-finance person. Sometimes it can just be too much, and it can be just bit too much information sometimes. So let's try and simplify it and make sure that you know what are the things that you want to look at so that you can do the best thing for your business. So thank you very much. Next week we have a oh, what do we have next week? Let me tell you. I can tell you that the last Friday of this month we have Nigel joining us. Um, so on the 25th, we have Nigel's joining us, and we're talking about succession planning, how best to plan for that, but getting all your documents in a row. But next week, we are going to be, oh, it's me again. I might have a guest with me, but I'm going to be talking about secrets of reducing your corporation tax bill. So it's not to be missed. So make sure you join me Friday, the 18th of February at 12:30 to find out the key things that you could be doing to reduce your corporation tax bill. Anyway, have a lovely, lovely week. Yes, I could do with water for the hiccups, Guy. I will be on that in a minute. Um, have a lovely, lovely weekend. Don't forget it's Valentine's Day on Monday, so go and get your cards and your flowers and have a lovely, lovely weekend. Cheerio.